Hey guys, welcome to Talk to Tina on a Tuesday. Thank you for joining me today. Today we're going to be talking about something that is important, especially nearing the end of the year, and it is basically just going to be calculating your tax bracket. So I do want to let you guys know that my information is not. I have to do with the disclaimer. It's not provided to provide you tax or legal or accounting advice. If you want tax, legal, or accounting advice, you should contact your attorney and your accountant. But you can kind of pull this information right off of the IRS website. So I'm going to share my screen here. Let me share the screen. All right, there we go. All right, so guys, is that flashing for you? Because it's actually flashing for me. Let me see here. Right. Okay, guys. All right, I want to share my screen here. I'm hoping you can see it. It's popping up there. All right, well, it was there. Here we go. All right. Let's get this back over here. All right. All right, popping this back over there. All right, thank you guys for holding on. So I want you to go to it's the IRS form 1040 and 1040 SR, and you kind of want to look at preparing for the end of the year, where you're going to be at. So here's the question. I had a couple of clients, and then myself and my husband were planning to hopefully not pay so much in taxes this year. So if you, let's say for instance, you are married and you have a income between 100 and 168, and you guys are married filing jointly, if you go over that 168, let's say you go to 169, then you're going to be paying an additional 2% in taxes. Okay. So that might not sound like a big deal, but it could be a big deal. I mean, if you are doing some overtime and you're getting ready to, you're doing overtime, you don't want to be, paying it to the government. You want to actually be able to keep more of your money. Also, let's say you are single. Let's say you are single and you were making right at 160, and then you made $161,000. You're going to jump from 24% interest rate to 32% interest rate. So let me kind of just put that into perspective, because I got a lot of clients that drive trucks, and they're out there working, and they're making that kind of money. So let's say you were at 160,000, and then you were at the 24% tax bracket. That means you're going to pay $38,400 in taxes. But let's say you made a couple of dollars over. Let's say you made $161,000. That's going to take you to that 32% tax bracket, 32, and then you're going to be paying $51,000 in taxes. That is actually a like a $20,000. Let me see, what is it? 160 times 0.24, 38 minus 51,000. That's like a $12,000 difference. So you want to kind of really look at this. If you are working a little bit of overtime, or you're humping it toward the end of the year, you might want to stay home so that you don't go over the threshold and cause yourself to pay thousands of more in taxes because you just made a couple of more dollars. Now, obviously, if you're way over it, then of course you're going to be in that tax bracket. But you want to kind of look at where you are, and if you can kind of see where you're going to be at. Now, another question that people have, I deal with a lot of business owners, is sometimes they believe that if you file all the money that you earned, you're going to be taxed on it. So that's not true, actually. I'm going to take you to the Schedule C here. And basically, this is if you're an LLC or a sole proprietor. Your accountant's probably going to fill out a 1040 with a Schedule C. On your Schedule C, you're putting your gross receipts, any cost of goods sold. So, say for instance, you're a restaurant. Um, you're a restaurant and things like that. You will take off the cost of your food there, and then that will be your gross income. But then you also have things for your business that you're going to be spending, such as your advertising, all of your business expenses. Now, sometimes this actually comes out to be a negative number, so that could decrease the amount that you owe in taxes, on your full taxes. So you're going to have that 1040. They're going to take that money off of there, and then your adjusted income is going to be adjusted less. Now, obviously, if you make some more money, if you have a profit, it's going to go to your regular income. The other things that, let's say you have a corporation, an S corporation, you're going to be filing two separate returns. One is going to be, if you're an S corporation, you're going to be filing 1120S, and you'll have something called a K1 that goes to your personal income. So basically, you put all of your business receipts, gross cost of goods sold there, take out all of the people that you paid, all the salaries that you paid, including yourself. Everything there. And you are going to have either a negative number or a positive number. And then, of course, that will go on your K1 and basically go to the shareholders to increase or decrease their personal tax liability. So, guys, I just kind of wanted to briefly go here and tell you, I did have a couple of clients that, the husband made over $100,000. The wife made, nearly, $100,000. And, they're doing a lot of overtime. And so if you're going to do overtime and cause yourself to create more taxes, you might want to take a vacation. That's what I got for you today. Thanks, guys. Hi, how you guys doing? Hi, Erin. How are you doing? So thanks, guys, for joining me. Hopefully that was helpful before the end of the year.